issue persists, let us know in the chat box and one of our events team will help you out. So without further ado, let's get started with the event today. And by way of scene setting, I had three initial observations I wanted to make. Firstly, we're at a pivotal moment. With COP26 later this year, there's a feeling that the political will now exists to make real strides forward. The Biden administration signaling a 6 times hike in the price per tonne of carbon last week is a real indication of this, and the UK government seems committed to the Build Back Greener strategy, even if the budget yesterday was a bit disappointing, and I'll touch on that shortly. And the city's response to Brexit and more globally competitive headwinds is to repurpose itself as the world's green financial centre. At OC, we want to tap into these themes of transformation, and our decarbonisation business unit is looking closely at the challenges and opportunities our clients face linked to financing the transition to net zero. Indeed, capital of all types, from growth capital and venture capital to private equity, institutional funds and debt, all have a key role to play. We at OC want to be at the centre of this transformation, and I hope you'll agree it's certainly an exciting time to be completely focused on the opportunities the green agenda presents. Secondly, yesterday's budget announcements. I'm not sure what you all thought, but sadly I felt there wasn't much transformative content in some of the announcements, and a good chunk of the green section seemed to me to have been reheated from previous statements. Of the announcements, perhaps the two most interesting were the establishment of the Green Investment Bank Mark II and a carbon markets working group to be led by Clara Furs. Also notable is a reference to an innovative reporting standard being planned for the Green Gilt programme. Perhaps more relevant for today, though, there were some promising financial commitments to energy innovation, specifically support for the development of new solutions to cut carbon emissions and accelerate near-to-market low-carbon energy innovation. However, this spending does still fall within the government's existing $1 billion net zero innovation portfolio. Nevertheless, it was good to see the launch of new competition to implement several first-of-a-kind energy storage prototypes and technology demonstrators, and 4.8 million subject to the business case for the Holyhead Hydrogen Hub. In respect of incentivising entrepreneurs, a key part of clean tech, a new fund has been allocated to invest in high-tech innovative companies, including those in the clean tech space. However, it will only support businesses aiming to raise at least £20 million of funding, so perhaps not as useful for entrepreneurs seeking growth capital. Finally, the government has also launched a consultation on enterprise management incentives used by many growth stage businesses. This is a very popular scheme, so let's hope the government doesn't do anything that will make it less attractive for clean tech entrepreneurs. Finally, by way of introduction, patient capital. Beverly and I wanted to put this event on today because we both passionately believe that patient capital is needed to deliver net zero. It's really important to have these conversations today with a wide spread of market participants to help in making the connections between fast growth, tech-savvy entrepreneurial minds and those with the capital they need to grow sustainably and deliver the clean tech solutions needed to achieve net zero. Our friends at the Clean Growth Fund are at the cutting edge of financing this clean tech revolution. And so it's with great pleasure that I now hand over to Beverly to add her words of welcome.
Thank you very much, James, and to Osborne Clark for co-hosting today's webinar. It's a pleasure to share my thoughts on opportunities for investors in the green industrial revolution with you all today. My name is Beverly Gower-Jones, and I'm the managing partner of the Clean Growth Fund. I'm delighted to be joined by the fund's two cornerstone investors, Mark Taylor from Bayes and James Bevan from CCLA, along with Sir Roger Gifford, who chairs the Green Finance Institute, and the Lord Mayor of London, Alderman William Russell. The front line against climate change is science and technology. It's innovation that enables us to maintain our standard of living whilst at the same time reducing greenhouse gas emissions. The world is transitioning to cleaner and carbon-free, and at the Clean Growth Fund, we see 5 key trends that are driving change and innovation, in turn creating attractive investments in these key areas. Where there is change, there is commercial opportunity. Energy is going distributed. No longer do we have central coal and gas-fired power stations, but many sources of generation, wind farms, heat pumps, solar on rooftops, to name but a few. And then it needs to be optimised. We need to manage this distributed power system to ensure resilience and stability. This can only be achieved with technology innovation, such as storage and demand response. Transport, we all see cars are going electric, but from petrol to clean and from clean to shared. Soon we will not own, but we'll lease our cars, and not long after that, they will be driving themselves. Waste is going circular. What was a linear process ending up at landfill sites is now waste being reused. And as we increasingly design to avoid it being waste at all, we're creating a circular economy with new value chains. The building sector is undergoing a transformation also. Modular construction from sustainable materials, not brick and cement, is the way ahead for new build. And for existing building stock retrofit schemes, where the homeowner moves from being a consumer to a prosumer, and buildings from being wasteful and costly assets to something that's energy efficient and revenue generating. Industry going green, fuel switching from gas and diesel to electric or hydrogen, capture and conversion of waste heat from processors to enable community district heating use, and utilisation of new sensors and controls to increase proactive maintenance. All these changes require technology, which in turn needs investment. And I look forward to talking more about these trends and opportunities in the roundtable session later. The good news for investors is that we're seeing an ever-increasing number of climate tech exits from these themes. Podpoint, LimeJump, ChargeMaster, Sonnen, Restore, and Panoramic, to name but a few, have all achieved exits within 5 years of the first VC round at multiples between 2.5 and 6.8 times. The Clean Growth Fund achieved a £40 million first close in May 2020 and is now raising an additional £60 million to reach the target fund size. The fund will invest in seed to Series A investments that will make a significant contribution to greenhouse gas emissions reduction or improve resource efficiency in those sectors that I have just been talking about. The fund is targeting 2.5 times return and a 19% net IRR. We've made 2 investments to date. The first in Piclo, a company that provides a platform or auction house for trading what's called flexibility in the power sector. Piclo have recently completed the world's largest auction, £14 million for UK power networks. And Indra, a smart electric vehicle infrastructure charging manufacturer. Indra have just conducted the world's largest vehicle-to-grid trial with Nissan. I would like to hand back to James Watson to continue our discussion today.
Thanks very much, Beverly. It's now a real privilege to ask William Russell, Lord Mayor of London, to speak about the position of the City of London and more widely perhaps the UK as a global green finance hub, and in particular the context of ventures and clean tech, green tech. So over to you, Lord Mayor.
Thank you, James, and thank you, Beverly. And it's always good to be on a panel with Sir Roger Gifford, who knows far more about green than I do and has done an outstanding job at the Green Finance Institute. But many thanks for inviting me to speak on opportunities for investors to accelerate the green industrial revolution and the road to net zero. Now, my colleagues at the City of London know that I love talking about the road to net zero, in particular, what I call the green brick road to COP26 in Glasgow. I also have been known to say, go green or go home. And if you aren't on that green train, it's leaving the station without you. But anyway, as you can see, I'm very enthusiastic about the whole green agenda. And well done to Osborne Clarke for organising this event and for all your work as leading specialists in the field of climate change. James, I was just on our virtual trip to Birmingham this morning, and I mentioned you and Osborne Clarke in my conversations. As Lord Mayor, it is my #1 priority that our financial and professional services industries should embrace, influence and accelerate the transition to net zero. And Osborne Clarke is a fine example of this. I was impressed by the work of your decarbonisation team, which I learned about during my own virtual visit to Bristol at the beginning of this year. And I hope you are able to take full advantage of your move to your new offices at the Halo building before too long. As I highlighted, earlier in 2021 is, of course, the year of COP26. By the way, I'll also say it's the year of the G7. So I think that's just pretty important as well. It's a very good stepping stone towards COP26. So it's a huge responsibility for the UK being right at the centre of the vital global discussions, which we all hope will be a turning point for the world. This is also an opportunity for the UK to drive the agenda, to lead by example and to bring even more international partners on board. We can do this because the UK is such an important centre for green finance, and we hope to host a finance pavilion during the conference to highlight just how important green finance is in the transition to a low carbon economy. This is a priority for the whole of the City of London. Last year, we launched our own climate action strategy to make the square mile net zero by 2040, 10 years ahead of the national target. And we hosted the Green Horizon Summit, bringing together over 100 speakers from around the world, where we saw the launch of initiatives such as the UK's Green Sovereign Bond and a new green taxonomy. Looking ahead, the City aims to work with government to implement the recommendations of the Task Force on scaling voluntary carbon markets to support the sectors where decarbonisation is most challenging. We're also working on the Finance for Sustainable Growth project to use the City's financial and professional services expertise to support green growth across all parts of the UK. Much of this builds on the excellent work of the Green Finance Institute, as you know, chaired by Sir Roger, and he is a past Lord Mayor, and I do try and keep up with him, so to speak. Government commitment is vitally important, and their investment in the Clean Growth Fund is a strong signal. It is also vital for private ventures to be investing in and scaling up green innovation, applying technology to enhancing existing systems and infrastructure, as well as developing new technologies to help address climate issues. Climate tech innovation needs venture investment, which is why the work of the Clean Growth Fund is so important. Opportunities in the green tech and clean tech space make excellent returns for funds and institutional investors. As Mark Carney says, this is the biggest investment opportunity for a generation. And the transition to net zero is not just a challenge, but also an opportunity to place ourselves at the centre of the green industrial and financial revolution and achieve clean and sustainable growth for the future. So I hope you can all take these opportunities and help us to accelerate down that green brick road to net zero. Thank you.
That's great. Thank you very much indeed, William. Much appreciated for you joining today. So we now move to our fantastic panel. I'll explore a few topics with each of the panelists, but please do add your questions using the chat function, as we will open the questions to the floor straight after the session. Kicking off with you, Beverly, you touched on this in the introduction, but in terms of target focus, where is the Clean Growth Fund targeted and why are you focusing there?
So thanks, James. The Clean Growth Fund is targeted at seed and Series A investments where the technology is proven and there is a clear product market fit. So there'll be pre or early revenue generating companies where there's a clear greenhouse gas emission reduction or resource efficiency potential. It's in that place where entrepreneurs need £3 to £5 million and where the angel and grant funding can't quite reach because the check size is too big. And it's too early for the generalist venture capital firms who are typically looking for revenue generation in the low millions. Why? Well, because we have evidence that early stage funds are best positioned to create and monetize value. It's not the same as in 2008, where solar needed hundreds of millions before an exit could be achieved. As I said in the introduction, since 2011, a large number of companies have achieved successful exits to corporates and good multiples. In the infrastructure fund space, there's competition caused by lots of capital, but fewer projects. So we are seeing a trend where infrastructure investors are seeking early access to pipeline. And so we're increasingly interested in exploring investment in venture capital funds to provide that access and that view. We're positioned at the kind of nexus of this interface. And I suppose the kind of last part to that answer is there's a vast, huge opportunity. In the past 10 years, there's been billions of pounds put into grant funding of innovation. And yet traditionally, there's been a real gap at this stage in the market. The kind of funding ladder has been broken. So when we opened the Clean Growth Fund, we had over £500 million of deal flow, which I think proves the point that there is a real need for investment in this place. And a huge number of those investment opportunities are extremely attractive.
That's great. Thank you, Beverly. Over to you, Mark, next. The UK government is responsible for grant funding, but with the Clean Growth Fund, it is operating as a private investor. Why did the UK government invest in the Clean Growth Fund, and how do BEIS and the CGF work together?
Okay, so the reason we wanted to invest in this fund was that we felt there was a gap, just as Beverly's mentioned, there's a gap in the market for those early stage, so pre-seed A and seed A investments. And we wanted to catalyze that. We felt the best way to do it was to show government commitment and to provide leverage and lead by example. And what we did is we ran a competition to appoint a fund manager to run the fund. And this gave us an opportunity to identify a candidate, as well as being a capable team of running and realizing returns, also achieving a team with deep sector knowledge and the experience of incubating and developing a wide range of companies. And that's why CGM was successful and won the competition to run CGF. One of the requirements is that they needed to have match our funding. Just as I'll explain how we work, the government is actually slightly less than 50% of the fund, and that is because we don't want to control the fund. And the most important thing for us is that we could show that a fund manager could independently make investment decisions and make a return. The one thing we do bring is our pipeline. As Beverly mentioned, we've been running grant schemes since 2012. Our last scheme for 5 years was 500 million. We could see quite a lot of technology being developed, quite a lot of companies being developed, but not progressing into the market. And that meant two things. One is we weren't getting the penetration and the impact that we wanted from our investment, but also it meant that the investors were missing out on an opportunity. And that's why we were so interested in investing in this fund.
Great, thank you, Mark. Over to you next, James. As one of the cornerstone investors in Clean Growth Fund, what convinced the UK's largest charity fund manager to invest in the Clean Growth Fund?
I look across the city and I would regard ESG as the most overworked and misapplied acronym that we can possibly imagine. And it's sort of offensive that people talk the talk but don't walk the walk. And if people genuinely believe that varying the weightings to existing quoted equities can do anything to get to net zero, then they are sadly very mistaken. And we were of the view that if we are to participate in getting the economy to net zero and delivering long-term sustainable returns to our investors, we needed to be providing primary capital participation. We needed to ensure that businesses that were capable of making a difference were appropriately funded so they could deliver in the way that we so desperately require. Now, we were not able to do this directly ourselves. We do not have the competence and expertise, but we did find in carbon limiting technologies and the Clean Growth Fund what we required in terms of competence, experience, expertise, and opportunities. So we were delighted to be co-funding.
Great. Thank you, James. Perhaps rivaling pandemic or Megxit, ESG seems to be one of the most used phrases of 2021 so far, and it's all the rage in the investment community. So over to you, Roger. Is this real or just a correct response to social concern about climate change? Where's the substance in ESG?
Thank you, James, and thank you for the invitation to join you to speak. Yes, it's real. I'm a banker rather than an investor, but the principles are very similar. And the substance, as Bev mentioned, is in the underlying technology, not least for the E part. I tend to think of S&G as best practice and sometimes best motivation, to put that out there. But I think the E is where we're seeing the really interesting development in technology. Many renewable energy technologies are now seen to be better than fossil fuels, either cheaper or more convenient or more in tune with the times, but they're better. And that's what's driving the change and driving investment and returns as well. Far more, I would argue, than societal concern, though that's very important to give the support for the revolution that we're now seeing in this area. But people and institutions are not investing in new energy tech for lower returns, just to make that absolutely clear. In fact, Lord Mayor referred to that in his opening remarks. This is not about lower returns, it's about better returns. And if we see stronger environmental regulation, or if we see a global carbon tax, this will only increase the investment attraction of new energy tech. It's also got substance in the reaction of shareholders and the public at large to what is acceptable behaviour and what is not. And we all know of situations where external events, from oil spills to throwing someone off one of your aircraft, can have a serious disproportionate effect on your company's share price. This is important. The CEOs don't like it when their share prices go down. It can also work the other way around. Amazing to see how Exxon's share price has reacted positively just this week as a result of adding 2 board directors who are going to be arguing for less capital spending on fossil fuel development. Quite remarkable. So yes, I think there's lots of substance, particularly in the E part of ESG. Thank you.
Great. Thank you, Roger. Back to Mark again, if we can. What's the government doing to foster an innovative clean tech sector in the UK? And can you give some examples around government-funded successful UK clean tech companies?
Certainly can, James. Obviously, the Clean Growth Fund, I think, represents a significant investment and shows the government is committed and serious about it. I think what I'd like to talk about is our ongoing grants programs. So I mentioned that we had 500 million from 2015 to 2021. This has been doubled, as you mentioned, to 1 billion from 2021 to 2025. And we're already launching programs on that. And I think to give you some examples of what we've achieved through grant funding, 3.5 years ago, I was asked to run Hy4Heat, which was looking at the potential for using hydrogen to heat homes. And at the time, it was basically an idea from the GDNOs to the gas distribution networks to ensure their long-term survival. But we did not have the technology or the knowledge to know whether we could actually use hydrogen in the homes. In the last 3.5 years, we've run an innovation program. We've run with over 50 contracts and over 30 entities involved from both companies, universities, and institutes. And in that time, we have developed hydrogen appliances, so hydrogen cookers, hydrogen boilers, hydrogen fires that are all performing to a high safety standard. We've developed hydrogen meters and built up a whole community and got them to collaborate and work together. And most importantly, we've developed the safety case for a domestic setting. We have worked with a wide range of people doing extensive experiments throughout the country and testing to prove that hydrogen can be safe in the home. And at the moment, we have a safety case sitting with HSE, and I'm very optimistic we'll get a positive outcome, which will allow us to proceed with trials next year. That will be up in Scotland, which is the H100 program. So hopefully that gives you an appreciation of how we try to catalyze stuff, get large numbers of companies together to move us forward significantly. And what does that mean for the investment community? That means there is an output for hydrogen. So one potential output for hydrogen is domestic heating. 85% of UK homes are heated by hydrogen, and that is something we can now put on the menu, which shows that any investors in hydrogen should be looking for that as an opportunity. Other examples I could give, obviously, I have to plug the 2 companies that CGF has already invested in, so that's Piccolo and Indra. Both of those companies benefited from our grant programs historically. That was completely independent of us. I know Beverly was aware of one of them because she was responsible for supporting us on the ERF, but the other company was actually supported as a secondary program, supporting Nissan's V2G program. So it just shows that we are developing a pipeline that can have an impact. Other exciting things that we've done are the UK's first carbon capture plant. That's up in Tata Chemicals, will be commissioned this summer. It will capture 40,000 tonnes of carbon, which will be used to make medical grade sodium bicarbonate. So hopefully that shows you the kind of impact we can have. And while we can talk about infrastructure programs, about transport and storage, it's also very important that we are demonstrating that carbon capture can happen in the UK. Other things I would highlight are companies like Ceres Power and ITM Power that all benefited from our grants and are now achieving strong growth. So I think hopefully that gives you an appreciation of what we try to do, James.
Yeah, it does. It's a really broad spread there of technologies, which is really important, I think, rather than putting all of our eggs in one basket. Beverly, back to you, if that's all right. Next, recent reports from BEIS have indicated that 70 billion will be needed to be invested in the UK per year for us to reach net zero. 40 million or even 150 million is such a small amount compared to the billions that will be needed to be invested. So why isn't the Clean Growth Fund bigger?
So the 100 to 150 million for the Clean Growth Fund will be the perfect size to do the job that it's been created to achieve. So what do I mean by that? Well, CGF is positioned to invest in the commercial demonstrators, be that hardware or software, that kind of first of a kind, to be able to move them from research and development into scale up and roll out. And that proven product market fit, where entrepreneurs struggle to find that funding, the 3 to 5 million kind of range is the sweet spot. And so, at a 100 million fund size, we aim to make approximately 20 investments over the kind of 5-year period with a team of 10 or so people, and return that important 2.5 times back to our LPs. If we had a fund of 500 million or $1 billion or whatever the number might be, to be able to do that important job, which is in this target area that I spoke about earlier, which is broken, we'd need to make 100, 200, 300 of the same size of investments, which in the period and with the the kind of quantity of staff and people that would be needed is impossible. The only other solution would be to increase the check size, which is what you see happen a lot when you get bigger fund. The only way they can manage that money is to write much bigger checks. And of course, if you do that, then you're not targeting the mission that the fund was set up to achieve, and that we know that the sector absolutely really badly needs. Clearly, clean tech innovation needs more than 100 million, as you said. And one of the key aims of the fund is to encourage co-investment and waterfall much more private money into the sector and accelerate that private finance from corporates and from other organisations and institutions.
Yeah, great. Thank you, Beverly. And just following on from that, Roger, is all the investment required actually affordable?
Absolutely, particularly when you can move private capital in alongside a kind of public incentive at the front. The problem is not the cost. The problem is the time frame. A major new plant like a power station or a wind farm, it can take 5 years to plan, getting the land that you need, getting the design approved, getting the constructors on site, and then it can take 5 years to build. And once built, there's a 10-year or longer write-off period, which of course the companies then will defease in their accounts. So going to a company that's 12 years into this cycle and saying, get rid of that and now let's put up a nice green plant is very difficult. So that plus the defeasance period of at least 10 years for most big projects means that the time is the problem. Company typically doesn't take the full cost of new capital expenditure into 1 year's accounts. It spreads it over the expected life of the facility. So persuading them to close a 2-year-old fossil fuel energy plant and replacing it with low carbon, very difficult to do. And this is a challenge we need to overcome. And we're starting to think about innovative financing methods which could help that. But essentially, there's an issue there. And that's why we talk about 2030 for the soonest we can make change, because we've got this 5-year plus 5-year plus extension after that, a period that companies have to plan about. So, it's an issue. Actually affording it, I don't think is a problem at all.
Yeah, I agree. There's a lot of appetite for these new technologies, and balancing that up with intermittent generation. There's clearly a long-term pipeline of transactions that we can all participate in. Back to you, James, if that's all right. It seems that investors are keen to do something in alternatives, but have not yet decided what actions to take. So do investors understand the sense of urgency, and are things moving at the right pace? And what needs to happen to turn the strategies into action? How long is that going to take?
I would say that there is a bifurcation between those investors who recognise the absolute urgency to arrest and then reverse climate change, before we reach the tipping point. We know that we have to do more. We know that we have to have firm progress, and we have to have hard targets. Change is always difficult. Change is usually unpopular. If we do not get change, we will fry this planet, and we cannot possibly allow that to happen, because it is an existential risk as opposed to simply an investment performance risk. So I do think that there is an element of the investing community who appreciate the urgency and who appreciate the gravity of the situation in which we find ourselves, but also who appreciate the opportunity that lies ahead if we can get this right. I think that there is, however, a group of people who still spend too much time talking and not walking, and who think that it is reasonable to defer actions, people who track indices, for example, who are allocating capital on the basis of historic business models, who do not have perhaps the sense of imagination, urgency that we have to have if we are to combat climate change and find a better and sustainable future. And I do think that finding a sustainable future is part and parcel of seeking strong long-term investment returns, so that there has certainly been a vogue element to say, well, do you know, if you want to follow a sustainable green agenda, it's going to cost you. I have to say that I think the evidence is completely to the contrary, that a green investment strategy seeking solutions to the problems of today in a way that can deliver strong capital returns is absolutely about maximizing long-term financial returns, as well as delivering excellent extra financial risk control.
Yeah, I agree. And beyond that, I think some of it as well is in picking some of the winners, so that there are good news stories to bring forward. Back to you, Roger. People are always referring to, and in some sense are concerned about, as I said, picking the winners. Bill Gates in his book, which I'm sure you've got, and I'm not plugging here because I get no royalties, but it's a very good book, speaks about that fact. So how do we know that the technologies we are investing in today will be the winners in the long run to net zero?
We don't, and nobody ever has done. Which is why we need lots of investments into lots of different technologies. But we do know the direction that we're going in, and we can be pretty sure it's less carbon intensive. But this uncertainty is not new. History tells us that most successful technologies, from steel production through cars and tractors to the IBM personal computer to the internet, they take something like 20 to 30 years to develop below the radar. They then disrupt when the price and the efficiency mechanism kicks in for the next 30, and then they mature, and they usually need to be regulated and taxed in a different way. You could say internet technology is entering that third phase now, where it needs better regulating and certainly better taxing for most of us. Renewable energy is just entering the second, the disruption phase. But the technology of, say, the automobile developed hugely between the car's introduction and even the vehicles that were being made in the 1940s and 50s. They're radically different again today, and they will be radically different again in another 10 or 20 years. Different firms competing with slightly different technologies, building on each other, buying each other up, and progressing through that way. And telling in advance who the winners are, that's never easy. So spread your investments. And I'm sure, I hope James would agree with that. It will be the same with renewables. The focus today may be on wind and solar. It may be something quite different in 10 years' time, such as hydrogen, which is looking promising, but not there yet. And already there are voices calling for a curtailment of biofuels that are a fuel source of clean energy, because you're still burning, at the same time as the airlines are looking whether they can replace jet fuel with biofuel. So, you know, that's the fun of the market, isn't it? Not knowing what's coming up next.
Yeah, and the adaptability to those new types of technology, the risks inherent in them to unlock their potential. I think that's where you come back in, Beverly. It's apparent from the discussion that we've had so far, the level of required investment and the benefits in terms of risk mitigation. As a first-time fund, why is this a good thing, and how do you demonstrate track record?
I think emerging fund managers are a really good thing. For the Clean Growth Fund, I think that that boils down to the fact that we're keener to outperform than established funds. We have more to prove. We have a differentiated strategy and approach. I think that we're very innovative in the deals that we source and structure. And importantly, we're very open and transparent and willing to work with our LP investors to form meaningful partnerships. So I think that's kind of like the first part of the answer there. Individually, both Jonathan and I at the Clean Growth Fund have track records and have known each other for over 20 years and worked together at Kinetic, where we were part of the corporate growth story for Kinetic's IPO. One of the examples there, we created a spin-out called Stingray, which was sold in 2011 at a return of 4.3 times and an IRR of 38% within the 5-year period. And that's something we're replicating at the Clean Growth Fund. I think so. It's not like it's kind of brand new in total. You know, we both experienced and we've worked together. I think it's worth to note that the government, as Mark mentioned earlier, tendered the 20 million cornerstone from the public purse, and that we were ranked top in, I guess, I don't know, but I imagine 12 or 15 or so funds. And track record was a key part of the selection criteria. I remember spending hours writing that section of the proposal. And competitor funds, I'm sure, included many of the UK's well-known and respected VC fund managers. So actually, I guess in some ways, you know, you could say that making venture capital investments into clean tech is unusual for all fund managers. Having a license to drive a car doesn't help you sail a boat. And what do I mean by that? What am I trying to say? I think it's that the fund manager who has a successful track record in the Internet of Things or digital or software as a service business model investments doesn't have a proven track record for clean tech. And it needs different and special things. So we believe that a successfully managed this type of fund into early stage clean growth companies, 2 areas of real expertise are required. One, and the Clean Growth Fund brings those together genuinely in both areas. So the first is a deep sector knowledge, which we have from over 20 years working in the clean tech space. I first founded Carbon Limiting Technologies in 2006 and have worked with over 400 clean tech companies in that time. And the second is a track record of early stage technology investing, which we have in the in the team. Lastly, I guess the last part of the answer is that I've been speaking with the European Investment Fund, and they've sent me some information and evidence that show that for the 60 fund managers they back, a third are emerging managers. And they tell me that over the last 10 years, first-time funds have represented over 40% of their best performing funds. So put another way, when I look at that data, 5 out of the 10-year period, over 5 years of the 10-year period, first-time funds have performed the best out of all EIF fund investments. And that probably is, the kind of combined look at that track record and why I think first-time funds are really, really great.
Fantastic. Yeah, thank you. Back to Mark now. With the 10-point green plan, the government's looking to match private investment on a 3 times multiple to taxpayer investment. What reassurance can government provide to investors considering the clean tech sector?
Okay, I think the of the 10-point plan is mostly in the targets that it sets. Like, for example, it says no petrol cars, diesel cars from 2030, no hybrids from 2035. That suddenly locks in a lot of things that have to happen. It means that we have to electrify cars, which means we have to have a flexible grid, which creates opportunities for companies like Picklo to come in and grow and make significant impact. Other things that are coming in this year, so there's a lot to come this year in response to the 10-point plan. So I'm going to read them out so I don't forget any. We have a heating building strategy, we have a hydrogen strategy, an industrial decarbonisation strategy, and a net zero strategy, all are coming this year. I think the most important thing, potentially for this audience, is to know that alongside those will come 2 very, very important business models. One is the hydrogen business models, and the other is the carbon capture and storage business models. These are going to be really critical when making investment decisions. And from my personal point of view, so many of the programs that I've worked on for 4 or 5 years now, progressing them through the technology readiness levels, and then didn't get them into the feed, we're eager to see them get to FID. And obviously, you need a business model to get into FID, and I think that is the period we're coming in. I think we really are, as I think William mentioned at the start, this is the year to start making it happen. We've got the 10-point plan, and we've got COP26 in place. And the other reassurance I think we can give is, as well as our monetary support for the Clean Growth Fund, we're active limited partners. We have a pipeline of 576 companies from our previous program, and we'll continue to grow that pipeline as we progress with NZIP. And the other important thing, which I think was good news from yesterday, James, you were probably a bit less bullish about the budget than I might have hoped, but I'm not a politician, I'm partial civil servant, but there were some, I think, important signs there with the Infrastructure Bank, although we did have one before, the Infrastructure Bank, and also the Green Gilts. I think that should give some assurance to investors that if they invest in equity funds like CGF, that in time, the capital will be available for those large infrastructure deployments to happen. So Roger referenced the wind farms, for example. So we have a lot of companies that we're supporting developing new technology, the next generation of offshore wind. We have a program that actually we announced yesterday, which is the floating offshore wind program, where we're looking to develop technology around, for example, flexible cables, floating platforms, and optimizing the performance of that. The opportunities for those to be deployed at scale by showing that Infrastructure Bank will come into place will allow us the opportunity to ensure there's a liquid capital market for those things to be deployed. So it's not like you're investing in something that won't, it will be deployed. And the reason I can say it will be deployed is because we have, by law, to meet our carbon budgets. Carbon budgets are a big challenge to achieve. And that means we've got to start delivering, we've got to start deploying. And that's why this year we'll be emerging with business models, both hydrogen and carbon capture. We need to start doing. And I think James emphasised, we need to start doing now. Otherwise, we will have a very hot planet that we will not be able to survive on.
Absolutely, yeah, and well said there. Back to you, Roger. And building on that point, actually, to some degree, how are investors persuaded they aren't going to have to sacrifice returns to achieve some of these politically set ambitions to achieve net zero?
Yep. Thanks, James. I mean, they shouldn't have to if the politically set ambition is backed up by action such as an incentive or deterrent, as we discussed earlier. In our society, nobody forces a fund manager to buy something he doesn't like. It's as fundamental a rule of liberty that we have in our country as any other. You're free to do almost what you want to do with your own money. And that's why I think we have to face the fact that we will only achieve the green transformation we want to achieve if those new technologies are invested in and developed alongside a government policy which is supportive. So it's why the Clean Growth Fund, I think, is just a fantastic thing to be doing. It was one of the principal recommendations from the Green Finance Task Force a couple of years back. It's great to see Beverly running that. But I think there'll be pandemonium and market breakdown if investors or people, institutions, start to think that they're going to have to take lower returns for politically set ambitions. The technology is how we make sure that doesn't happen.
Yeah, it has to be viable. Completely agree. Back to you, James. In terms of actually achieving net zero, will divesting from carbon intensive stocks into more environmentally friendly ones be enough to reduce greenhouse gas emissions, or does more need to be done?
It's absolutely insufficient to move the needle adequately on the carbon burden that the global economy is weighed down by. If one thinks about what happens when capital is traded in the stock markets, you sell a share, somebody else buys the share, but there's no fundamental shift in the allocation of capital to the company itself. And indeed, if you depress share prices, you may find that companies are unable to make the changes they need to make to be able to support a cleaner tomorrow. But I worry far more than that fundamentally we need to embrace new technologies, new ideas, new ways of doing things. This is about the front foot. This is about being sure that we are able to find a route forward, but it's not simply about attempting to diminish carbon cost of existing technologies, but it's about opening the door on a whole new way of doing business, thinking about how we can have sustainable growth, and about therefore enhancing probable forward returns and sustainability. And I come back to the reality that if we don't get this right, quite apart from the existential crisis, we will face a torrent of legislation, regulation, maybe litigation, and most certainly customer action that will drive the agenda towards an increasingly green perspective of how the global economy needs to be managed. And therefore, forward-looking fund managers, I think, are absolutely necessarily going to have to embrace the challenge of carbon limiting technologies and clean growth. This is absolutely part and parcel of both supporting strong investment returns, but also about having an overall sustainable future.
Yeah, I completely agree. Just back to you quickly, Roger. Actually, I mean, the GFI, just responding to that, has been set up to act as a kind of public-private initiative. In terms of the carrot and the stick, what do you see the role of government from a green finance perspective?
Yeah, thanks. I mean, I think Mark did a really good job outlining a number of the projects that are coming along, because, I mean, I think government has a really strong role to play, working with companies to find solutions to challenges like the one I mentioned earlier around capital expenditure depreciation, something we're looking at. Tax is obviously a very powerful tool as well, both as an incentivizer and a deterrent, encouraging green assets with allowances, discouraging brown assets with extra taxation like a carbon tax. One of the things we're looking at very strongly is voluntary carbon markets, which the Lord Mayor is well aware of too. A global carbon tax has been proposed for years, and were this to be achieved, we would completely shift the balance of corporate thinking towards green. You may know that Sweden introduced and has lived with a carbon tax which is now over €100 a tonne for many years, encouraging industry to invest in cleaner energy and industrial solutions. And crucially, this is a challenge in those economies that are further away, which are producing the most carbon from industrial use. And they tend to be high growth countries, China, India, parts of Africa. So it's sort of, the global carbon tax will be really difficult to bring in politically, but it's something that would make just a huge difference. So governments have this very strong role to play in helping at the venture end of the investment cycle as well, hence the Clean Growth Fund, as I mentioned, or Beverly's Clean Growth Fund, which was a key part of the early green finance thinking. And I think governments can promote an understanding of climate risk and measuring it through central banks and other formal institutions. But the most important thing today, and again, interested in James's view, there's lots of money wants to invest in green. We need more projects. And government is crucial in bringing those projects forward, which is why Boris's 10-point plan, which a number of people were very rude about, I got very excited about, because if we just carry out a proportion of it, we have a lot of new projects coming along for investors, private and public, to go into together. So the work of the GFI is very much focusing on those opportunities, mobilizing capital, real capital into real projects. We just want more projects, is what we really want.
Yeah, I agree. And I don't know, Lord Mayor, this is a slightly unscripted question, but I hope you'd be all right to answer it. Obviously, building on what Sir Roger was just saying there around the role of government, clearly the role of the corporation and the city more widely to build that framework and that encouragement for clean tech and green investing is a major part of your sort of mission this year. What confidence can you give to the investors on the call today that the city is fully behind this green future?
Well, part of the confidence I can give is that when I travel overseas, and Alan, you can hear me, yes?
Yep.
When I travel overseas, and particularly in the Gulf, they have made it very clear that they want to invest in green and sustainable projects here in the UK. And Lord Grimstone, many of you may, obviously Mark will know this, has set up something called Office for Investment, which is this new Office for Investment based in Number 10, I think 7 to 8 people, and it's all these big projects are going to be shown to our friends overseas as well. I mean, one of the biggest issues I get worked up about, which I'm sure James will relate to and Beverly knows what I'm talking about, is, yeah, and it's going to change, and that's where the Jonathan Hill review is going to be part of that process. Listings is just the start of it, is that the amount of money that pension funds aren't able to put into some of these great startups that Beverly sees. And as my friends at Omar's, one of the big Canadian pension funds run by Tessa Reeves, whose English says, here am I investing for our Canadian teachers, and I invest in all these wonderful projects I see in the UK, and none of our pensioners are able to benefit from some of these projects. So I think you'll see a change where that's going to be more prevalent by government to make sure, because the average holding period is at least 5, sometimes 9 years, and we as pensioners, I think, have missed out quite a lot. Yes, we have a great startup culture for EIS and SEIS, but what we miss out on is that scale up. And I think you'll see that the Chancellor has got onto that, and that review from Jonathan Hill is part of that process. It's a much bigger thing than just make it easier to list. And the other thing I'd just add, which I'm interested to ask Beverly, sorry, James, to take this one from me.
Right, over it.
I sense there is so much money. I mean, just so everyone knows, $70 billion went into ESG funds from April to June last year. And I'm beginning to read about the green bubble that may be developing. I don't know whether you're seeing that at all, Beverly, out there, where valuations are going up because there's so much demand for anything green that and there are too fewer projects and too much money after that demand after the projects.
I think what we have to do when we talk about this is kind of really segment and segregate the difference between debt and project finance into projects and equity finance, venture capital into innovation companies. And in the venture capital equity space, which is where we are, there is still very little money and loads of projects. I had £500 million worth of deal flow come to me in the first 6 weeks of opening the Clean Growth Fund, because it's extremely difficult for entrepreneurs to get the money they need to build what I call those first of a kind, first time commercial demonstrators, where they really need, £5 million to actually prove commercially that their product or service, be it hardware or software, kind of really does what it says on the tin. And because we haven't invested at that stage for the last 10 or 15 years, that's why you've got no projects, because they can't prove. And so the reason I set the fund up was to absolutely target that space, so we can prove commercial projects that you can then take forward into debt finance and scale up and roll out many loads of, so that you'll have the projects that you need to be able to invest the debt in to be able to scale and grow. But until we do the first of a kind commercial demonstrators, we won't ever make any progress. And this funding ladder has been broken for so long that it's at a really critical point. And I think that's the whole crux of the problem, actually.
Yeah, good answer. Finally, back to James Bevan. If you could give investors listening to this one piece of advice, what would it be?
It is to think about the long term. It is to think about the importance of sustainability, and it is to think about our co-responsibility in navigating a way forward that is both financially remunerative for the investors, but also which solves the challenge of living in the 21st century, because we do not solve the problem of climate change and the real requirement to decarbonize, we are going to have an unsustainable future, not just in terms of investment returns, but in terms of viability of life on this planet. It's as simple and yet as significant as that.
Thank you. It's a good way to end the sort of formal panel session. Thank you to all of the panelists. It was a really good discussion. We are going to move over to the sort of breakout and networking session in a moment, but there's been some really interesting questions from the floor. So I hope, if you don't mind, I'll just spend a couple of minutes asking a couple of those questions. One of the questions, Mark, perhaps for you, is effectively saying that, along Roger's comment around suitable projects in which to invest. Should the government and BEIS be looking at some of the educational establishments and co-investing, co-working with some of those universities and other institutions to kind of test some of the winners before they come through for these early stages of finance? I thought that was a really good question for you.
So that actually is the space we try to occupy. So we have a lot of links with universities. Actually, probably the person who asked the question would be to have a look at the Energy Entrepreneurs Fund, which we launched a couple of weeks ago. And that is really targeted at picking up those university startups. And we develop them and bring them up to TRL levels. I think most importantly, the thing that we've been doing in working with Beverly's carbon limiting technologies companies is also bringing these companies up to commercial readiness levels. Because although are quite brilliant in the UK, they're not always the greatest business people and not always the best people to build a business and turn it into a investable proposition. So that's why many of our schemes, we have incubation support. At the moment, CLT has that contract. We also seek to develop their commercial capabilities as well as their technical capabilities. And it's to do precisely what the questioner has asked, is to take those ideas and prove them. Now, I have to be honest, quite a few of those, they don't prove to be successful. So the good thing is with our grants is we can prove them one way or the other. And I remember I got asked by the previous chief scientific advisor about, Mark, what do we do about this picking winners argument? And I said, let's not worry about picking the winners. We need to pick the losers as government. So if we can filter out the losers, then the things that are coming through our schemes are proven. So we're delivering companies at TRL 6, TRL 7, so they've done the type of demonstration Beverly's talking about, admittedly only a prototype scale, but they're ready to scale up and start doing those first of kind deployments. So we have been working very hard and will continue to work very hard to take that through. What we typically find, I'll give you an example of Highview, who are currently breaking ground on their cryogenic store. It's actually a £70 million project. They have about 10 million from us. That is a company that we supported in EEF about 6 years ago, doing a very small demonstrator. So each time we've built it up and we've nurtured them, and now they're hitting commercial markets and they actually have a commercial deal with National Grid for flexibility services. So I think that gives you an example of what we tried to do. The bit that we were missing when I joined BEIS 3.5 years ago, was the bit at the end. And that is why we felt we weren't really able to pass off what was emerging from our programs into a venture capital arena, which is the appropriate place for us. And that is why we wanted to catalyze it by both launching the competition for a fund manager to run the Clean Growth Fund and then investing in it. So what we're hoping is that we will start to get a pipeline that will suck the outcomes of our grant programs, that inputs are coming from universities, suck them through and create a seamless pipeline. And then we filter out the ideas that aren't so clever or have commercial problems or have technical problems before they get into the investment stage. And that's why we're so delighted that CGF has already started investing in companies, even though it's only been going since the summer. And I can see a very strong pipeline ahead. I'm really excited that we will start to convert and get that pipeline flowing. And that gives all of my team, which is over 100 people now, the incentive to really work hard on delivering our work so that we continue to fill that investment pipeline.
Thanks very much, Mark. I think that's probably a good place to call the sort of formal bit to a close. So thank you all for joining us today, and thanks to all the panelists. Really has been a fascinating conversation. As trailed earlier, we'll now move on to question-specific networking sessions, which you can access via the networking tab there at the top of the screen. Each networking table has a maximum capacity of 50 people, so if you find that one table is full, please do try another. Point to note regarding video usage in the networking rooms, the platform will ask you to grant permission if you'd like to take part. That will just take a second or so. Please ensure that you're not running Teams or Zoom in the background, because this does tend to affect the poor performance of the platform. Each of our 4 keynote speakers will join one of the networking tables. And as a reminder, the topics are: will the climate imperative lead to opportunities for superior financial returns, which will be joined by Sir Roger. The second one is: which are the key emerging markets and technologies to invest in to achieve net zero, which Beverly will join. James will join the table entitled: will infra funds get better access to project pipelines by investing in venture capital fund managers? And finally, Mark will join: what are some of the risks and opportunities associated with scalable technologies? And from the questioning, a lot of attention is given to cement, concrete, and other steel production and so on, Mark. So I suspect you're going to get some difficult questions there. For those of you who have to depart now, you'll see in the chat box a link to a very short feedback questionnaire. I'd be grateful if you could answer that. We'll also be pulling together some of the themes that you have heard about today to act as a bit of an aid memoir for the attendees. So finally, many thanks, and we look forward to seeing you in the networking sessions very shortly to continue the conversations.